and other records, so that now you are able to be given loans in the business. And then number five, it attracts investors. Attracts investors. Investors are those people who can be able to join you in business to enhance your capacity and your ability to function or produce. So it attracts investors. And number six, it attracts investors. And then number six, it also helps to evaluate performance. Evaluate performance. So with financial information, you can be able to, it gives records of the current performance and the previous performance. Therefore, comparison can be able to be made, and we see whether the business is performing well or not. So these are some of the importance of financial accounting. And then we have users of financial accounting. We have users of financial accounting, call them stockholders or users of financial accounting, and why they are using that information. So we have users of financial accounting and why. So the first users are the owners of the business. We have the owners. Number two, we have the management. Number three, we have the employees. Number four, we have the government. Number five, we have the lenders. Number six, we have customers. Number seven, we have suppliers. And number eight, we have investors. So these are some of the users or stakeholders, those people who are interested in financial accounting. So you're supposed to know a user and why he's interested in financial accounting. So the owners of the business, we have three kinds of business ownership in Kenya. Sole proprietors for a business that is owned by a single person. And then we have partnership, a business that's owned by a minimum of 2 and a maximum of 20. And then we have companies. So those are the forms of business. So these owners, they want to know, they're interested to know whether their business is making profits or losses. So they want to know whether the business is making profit or losses. These ones, the owners. Then we have the management. Management are the ones that are running the business on a day-to-day basis. So they're interested in this financial information for decision making. They're making decision on decision making. So that is why they're interested in financial accounting. They want to make a decision on whether to hire more employees, maybe to acquire more products. So those ones, for you to make those decisions, you must be equipped with financial data so that you can be able to make those decisions. And then we have the employees, those people who are employed in the business or the business entity. The employees, they want to be assured of their job security. There's a job security. If the business that you're working for as an employee is doing well financially, then you'll be secure in terms of jobs. If it is undergoing financial turmoil or problems, then you need to plan. You need to have an exit plan so that you can now be able to find a new place that can be able to sustain you economically. It can also be used as a tool to bargain for better pay. So when the business you're working for is making profits, you can use that one as a tool to also bargain for better remuneration. So the government are interested with the taxes. They want to know whether the business is accurately paying taxes. So that one can only be revealed by financial accounting. Is the business paying taxes? Yes. If they're paying, are they paying accurately? Yes. So how will the government be able to know? Through the financial statement, and they can as well audit. Then lenders, they want to lend money to you. So they are the lenders who provide finances, capital for you. You also need loans so that you can develop the business, expand it wide. And you can't expand it maybe on your own strength. Sometimes you can be short of finances. So you need people to assist you So lenders will only be comfortable lending to you after analyzing your financial statement and to find out if you have the capacity to pay, capacity to repay. Do you have capacity to repay? That one will be revealed in your financial statement. Customers are the ones that are enjoying services and products that the entity is producing. So the entities are meant to exist to provide services and products. So these products are consumed by customers or clients. So clients are very happy when you're giving them services and maybe near where they are. So they'll be interested. They want to know that you're being squeezed in a way or there's an issue that is affecting your productivity so that I can step in and ensure there's a sustainability of the products and services. So then we'll call them customers of the business. Then we have suppliers. Suppliers, another name for suppliers is creditors. Creditors are those people, individuals who supply to the business on credit. So they are paid later on. So they're interested in financial accounting to know whether the business is in a position to pay them or to pay them when they supply on credit. Investors, these are people who can join the business as also owners. So they can contribute their money to contribute towards the capital of the business. So the investors are the contributors of capital. So they want to be assured that they will be. So people invest to get returns. So you can't invest blindly. You must analyze the financial statements of an entity in order to invest. And there's also we have financial advisors. They are those people who advise people on where to invest. So they only advise people to invest in companies that have presented their financial statements and which are sound. So those are some of the users of financial accounting and why they are interested. So these notes, I'll give it to you after the class. I'll provide the notes after the class. So we have those users of financial accounting. So accounting is a system. So we start with what we call the source documents. So after that, you need to know what you call the source documents. What we call the source documents. So the source documents are those documents that gives evidence of the occurrence of a transaction. So they provide evidence. They provide evidence of occurrence of a transaction. So they give evidence of a transaction. So they give evidence that a transaction has occurred. So you're talking about documents like, number one, we have the invoice. Number two, we have the credit note. Number three, we have the debit note. And then number four, we have the delivery note. And then number five, we have the receipt. We have number six, payment voucher. We have purchase order. Number seven, we have purchase order. Number eight, we have quotation, among others. So we have more than this, but these are the basic one. So we're going to discuss a few of them. So we have an invoice. An invoice is a formal document it's a document that originates from the seller to the buyer, formally demanding for payment for the goods that have been sold on credit. So it's a document that is sent from the seller to the buyer to request for payment. It is issued when goods are sold on credit. So it is sent by the buyer to request for the payment of goods that had been sold on credit. So it has the goods. These are the content of the invoice. There is a description of the goods, the quantity sold, and the amount. Those are the address of the seller and the address of the buyer. So we call it invoice. It's an official document that is sent to request for payment from the seller to the buyer. It is issued when goods or services are provided on credit. That is an invoice, a very important document. And then we have a credit note. When it comes to accounting, any recording, any figure that is recorded in the books of account must have an evidencing or a document that a document that accompanies that particular transaction. So we also have a credit note, that is number 2. A credit note is a document that is sent to correct an overcharge on an invoice. Sometimes when you're making an invoice, you can overcharge the customer either through mistake or maybe the customer can also return some of the goods that had initially been sold. So it means the original invoice that had been sold there, it will be more, it will be inflated, it will have more amount. So to correct that mistake, we need to have a credit note. So it's a document that is sent to correct an overcharge on an invoice. You can also undercharge. A debit note, on the other hand, is a document that is sent to correct an undercharge on an invoice. So when you undercharge the customer, it doesn't mean that the customer will pay the undercharge. You will give him another additional invoice. That additional invoice is called a debit note. So a debit note is a document that is sent to correct an undercharge on an invoice. Correct another charge on an invoice. Then we have a delivery notes. A delivery notes is a document that confirms delivery of goods. It's 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 a document that confirms a document that confirms that goods have been delivered. Goods have been delivered. So when you're delivering goods, the recipient must check and confirm that the goods are in good condition and are like they were ordered, and then confirms by signing the delivery note and stamping it, so that in case now they are following payment to that particular customer, there will be a document to evidence that the goods were actually delivered. Then we have a receipt. A receipt is a document that is confirms or shows a cash transaction. So every time there's a cash transaction, either receipts of cash, you must issue a receipt. When you purchase or you make purchases on cash basis, you also must be given a receipt. So it's a document that gives confirms cash transactions. And then payment voucher. You have another document called payment voucher. A payment voucher is a document that is issued to show the payment of petty cash on petty items. So when it's a document that shows the payment of petty cash out. So when you pay out cash, we have what we call a petty cashier. So you spend money on petty items like maybe minor repairs within the building, transport cost, and other small costs. So whoever is the recipient, whoever is receiving this money from the petty cashier must sign a payment voucher to confirm that he was paid money out. So you're a petty cashier, you can't just say verbally that you paid so and so without proving that that particular so and so has acknowledged the receipt of money from you through signing of a petty voucher. Then we have purchase order. So when you go to a business entity, they will give you what we call the catalog, a list of services or items they on sale. And then they'll give you a quotation. A quotation is an invitation to make an order. So they are giving you a quotation. A quotation is an invitation to make an order, an official invitation to make an order. So it gives you the terms of payment and terms. Quotation gives you the terms of payment and terms of trade. It invites you, gives you the terms of payment, terms of trade. And then now you issue a purchase order if you are satisfied with those two documents. A purchase order is an authority to supply. This is an authority. So when you receive this one, you've given them authority to supply. You've given them the authority to supply. So those are some of the documents that you need to know. We call them the source document. So we start with the source document, and then we go to the books of original entry. Books of original entry. We have books of original entry. So these are books that records source documents. So they record source documents. They are sometimes called journals or day books. Another name given to them is journals / day books. So sometimes we call them journals or day books. So they record source documents. So source documents will be recorded in a day book, in the day books. So some of the day books that we have, number one, we have what we call sales day book. Sales day book. Number two, we have purchases day book. Purchases day book. Number three, we have return inwards day book. Return inwards day book. Returns inward day book. And number four, we have what we call a journal proper. Journal proper. And then number five, we have petty cash book. Petty cash book. And number six, we have cash book. So these are the day books or journals. These are the day books or journals. And we are saying these journals or day books record the source documents. So once you receive the source document, you record it in the day book. So now I want to analyze one by one the day books. We know how we're recording it and what does it record. So we start with the sales day book. Sales day book. Sales day book. Sales day book number one. This one records credit sales only. It's a book of account that is used to record credit sales only. So it records credit sales only. And this is the format. This is how it appears. So we have the date, and then we have the detail. Then we have the invoice number here. Invoice number, and then we have the amount. So this is the appearance of the sales day book. So every time you make sales on credit, you record it in this book first. So you come here and record the date you made sales. For instance, you made sales on 1st January 2022. You sold to a company called Water Limited. Then you issued invoice number 101. The total amount of sales was 200,000 shillings. So if I want to know the total sales you made on credit in a particular day or in a particular time or period, let's come to this book. Then I will need to see the invoices that were made when those sales were being made. So the only principle that you follow when recording this book, that those transactions recorded earlier should be recorded first. If a transaction occurred first, it should be the one first to be recorded. That is what we call sales day book. And then you get the totals per day. Total per day. So that is the appearance of sales day book or journal or day book. That is number one. And then number two, we have purchases day book. Purchases day book. It is used to record credits purchases only. Credit purchases only. Every time a business purchases on credit, it records in this book called purchases day book. So all the credit purchases must be recorded there. It has also this format. So we have the date, here, and then we have the details, and then we have the invoice number, of course, from the supplier, and then we have the amount. So we like this. So this is purchases day book. So maybe on 1st also of January 2022. So you bought goods from Patel Limited on credit. So you write the name of the supplier and then the invoice number 002. As an example, and amount may be 1 million. 1 million. So the total value of purchases was 1 million. So all the purchases on credit will be recorded here, and then you get the totals. So this one follows a similar pattern. This one follows a similar pattern like this one. You only record it date-wise. Then number three, we have return inwards. Return inwards day book. Returns inward day book. So this one records sales returns. Sales returns. So every time customers, those people we had sold to, we call them debtors if the sales were on credit. If the sales were on credit, we call them debtors. Or the other normal one who bought on cash can as well return goods. So every time there are returns of goods to the business that had initially been sold, they must be recorded in this book. So we come here, this is the appearance, this is the appearance, this is the format, this is the diagrammatically appearance of that book. So we have the date, then we have the details, then here we have the amount. So those are the columns. These are the columns. So right here, return. Journal. Returning or day book or journal. Remember, this was also called journals. Maybe we had sold to Hotel Limited. After 10 days, Hotel Limited decides to return some of the goods that had been sold. So we write here the name Hotel Limited. So the value of sales that are being returned, maybe this is a creditor number, and maybe 20,000. 20,000. So every sales must be recorded. Every sales return must be recorded in this book. Then we get the totals. In case you have a question, you are allowed to ask. In case you have a comment, you are allowed also to post. So this class is interactive. You are allowed to communicate so that we are on the same page. Remember, we are doing Introduction to Financial Accounting. That is where we are. We're doing Introduction to Financial Accounting. So the next day book that we have is what we call returns outwards. Return outwards. So return outwards is a book of accounts that is used to record purchases returns. So sometimes when you buy goods as a business, you can decide to return some of them back to the supplier. So this one records credit purchases only. Sorry, it records purchases returns. It records purchases returns. It records purchases returns. And this is how it looks like. So we have the date here. We have the dates, and then we have the details. And then we have the amount. So maybe after some days, we decide to return some of the goods to Patel Limited. Remember here we had the company, the example I had given before. There was a purchases of 1 million from Patel, 1st January 2022. Maybe after 15 days of the same month, some of the goods that had been purchased from the Patel are being returned. So you write here Patel. We have ready to note number. Return goods to the customer, to the supplier. The supplier must acknowledge the receipt of the goods and sign a document called goods return note or issue a credit note. Whichever will come first, it will be indicated here. So the supplier must acknowledge the receipt of the goods back and sign a document called a goods return note to indicate that he has received the goods. So you write here maybe 21 or 211. 211 was the credit note, and then the amount maybe 50,000. So that is how a return outwards day book appears. That is how a return outward day books appears. Then we have what we call the journal proper. So it's a day book called journal proper. So there are the other transactions that do not pass through these other day books. So they will be recorded in this journal proper. So mostly it records purchases and sale of non-current assets. Purchases and sale of non-current assets on credit. So when you purchase and sell non-current assets on credit, you record it in the journal proper. So how does it appear? This is the appearance of the journal proper. It has two sides. We have the debit side and the credit side. So we'll learn about debit and credit in a short while, but in the meantime, just know that this one takes this shape. So we're going to know what does it mean to debit and what does it mean to credit. So DR indicates a debit and CR indicates a credit. So the account that is receiving, you will know also what is an account in a short while. Just be patient, but in the meantime, the account that is receiving you debit, and the one that is losing you credit. So we are saying we use this book to record purchases and sale of non-current assets on credit. So for instance, maybe 1st January 2022. So they bought a motor vehicle from Simba Motors on credit. So motor vehicle is the one that is receiving. So you write here motor vehicle. The value of the purchases is 2 million. It was on credit. And then you debit motor vehicle. And then here we have the Simba Motors. You credit it. The one that is losing. You can give narration being purchases of motor vehicle credit from Simba Motors, and then you underline. You can give narration being purchases of motor vehicle credit from Simba Motors. Maybe on 10th of January 2022, the business decided to sell an old furniture to Pangani Girls. So Pangani Girls are the ones that are receiving. So you write here Pangani Girls. Maybe the value of the furniture was 50, the value of sales. And then you write here furniture is losing. Furniture is losing 50,000. You can give it narration, say being sales of furniture to Pangani Girls, and then you underline. So that is what is called journal proper. Journal proper. So now at that point, you will realize that we have already discussed about sales day book, purchases day books, return inwards, and return outwards. So there's another one here that I left out, returns outward, although I have discussed about it. And then we have discussed about journal proper. So we are remaining with these two books, petty cash book and cash book. So these ones act as day books and ledgers. This one acts as day books and ledgers. This one acts as day books and ledgers. So I told you, accounting is a system. So once we have a transaction which is evidenced by a source document, which is transferred to the day books, and then from the day books, we now transfer that information to the ledgers. So before we know how to record information in the cash book, we will need to learn about ledgers. We need to learn about ledgers. So the information that is in the day books is transferred to the ledgers, and then from the ledgers, the trial balance, and then you make the statements. So that is how it moves. That is how it moves. Now we are finished with the day books. We are finished with the day books. We are saying there are around 6 day books, and we have discussed about 4 of them. They are remaining, which you're saying, they not only act as day books, but also as ledgers. Therefore, before we know how to post transaction in them, we will need to know what is a ledger and how we post in a ledger. So allow me to go to the ledgers. So we have ledgers. We have ledgers. We have ledgers. So what is a ledger? A ledger is a book of accounts where transactions are recorded either as debits or credit. It's a book of accounts where transactions are recorded either as debits in bracket DR or credits in bracket CR. So this is it diagrammatically can be presented as follows. So we have a ledger. This is how it appears diagrammatically. So it has the title here. It has the title. So the left-hand side of the ledger, is called the debit side, which is noted by DR. The left-hand side. And the right-hand side of the ledger is called credit, which is CR. And then it has the date. It has the date column, and then the details and amount. So on both sides, date, details, and amount. Date, details, and amount. So that is this is the ledger. A ledger is a book of accounts where transactions are either recorded as debit or credit. So when we say debit, we mean the left-hand side of the ledger. When we say credit, we mean the right-hand side of a ledger. So we have types of ledgers. We have purchases ledger, has the summaries of the purchases, and then we have sales ledger. We have types of ledger. We have purchases ledger, and then we have the sales ledger, and we have the general ledger. We have the general ledgers, the general ledger. So those are the types of ledgers that we have. When recording transaction in the ledger, so the source of information that is in the ledger comes from the day books. It's from the day books that we now get the information that we record in ledgers here. So we observe the principle of double entry. We observe the principle of double entry when we record transactions in the ledger. So there's a principle called double entry when you're recording transactions in a ledger. So this principle states in every business transaction, at least two accounts must be involved. Find the account receiving, debit account receiving, account. So that is the principle of double entry. In every business transaction, a transaction in business involves the exchange of services or goods for money. So that when we talk about transaction in business, we mean there's an exchange of services and goods for money. That is what it means by double entry. That is what it means by principle. That is what it means by principle of double entry. So we must have two transactions, at least two transactions in every business transaction. Alternatively, we can summarize here. Alternatively, we can have accounts. And then we have what we call personal account. And then we have impersonal account. So we have personal account and impersonal account. Under impersonal, we have real account, and then we have nominal accounts. So AC means account. AC means account. So what is an account? An account is a summary of transactions. It's a summary of transactions. So in business, we mean transaction, we mean there's money involved. So when you talk about that you're having an account with certain institution, maybe a bank, it means we have a summary of your transaction there. That is what it means by an account. So these are all the accounts that you can ever get in an organization. So under personal account, what are they called personal accounts? They are called personal accounts because they bear the name of an individual. So they have the bearing of an individual's name. The title is the individual's name. So these are accounts of debtors and creditors. All the debtors, are those customers you sell to on credit. All of them, you must have the accounts. All of them. If you're a customer anywhere, they must have your account. For instance, we have so many people who have subscribed as Safaricom customers, Safaricom limited customers. So Safaricom has a list, has a summary of each and every individual's account there. So you have an account with Safaricom with your name, it bears your name. So we are saying this account and debtors. So the rule here is you debit account receiving, and you credit account losing. That is the rule. You credit account losing. And then we have real account. We have assets, tangible assets, those assets that you can be able to feel with your hand. So under real account, you debit accounts receiving, credit account losing. Nominal account is account of expenses, and purchases, sales and income. So when we talk about nominal accounts, we mean purchases and expenses, sales and incomes. So here under nominal accounts, so debit, purchases and expenses are debited. You credit, incomes and sales are credited. So this is a summary of all the you ever meet in an organization. So when you're posting to ledgers, you must observe this rule of double entry. Provided an account is a personal account, if it is receiving, you must debit. If it is losing, you must credit. Provided an account is a real account. What are real accounts? Real accounts are accounts of tangible assets. Assets are an item of value to an organization. Example of tangible asset is land and building, cash, motor vehicle, machinery, computers, office equipment. Those are the items that you can be able to feel, or tangible items of value. So long as it's an account that is receiving your debit, if it is losing your credit. Then we have nominal accounts. We have explained what it is. So all the purchases and expenses are debited, and all the incomes and sales are credited. So this is the summary of the ledgers. Remember, you observe the rules of double entry when you're recording transaction in the ledgers. So having said that, we need now to learn how to do it. We need to learn how to do it. We need to learn how to do it. So there's a question that I've sent. There's a question that I've sent to one of us. You can see we have more than one participant, but today I thought we will only have one. But I've sent this question to her. So those other ones that do not have this question, maybe you can text me your numbers through this number so that I will incorporate you in a group, and then I will send you the questions and all the notes. So there's a number that I've written on the screen there. You can just text me your name, your phone numbers, and then I'll be able to give you, I'll incorporate into the group, and then be sending all the material that we need to be using in our class then. So there's one question that I've sent there, a cash book question. So there's a cash book question that I've sent. I've only managed to send to, is it so? So there's a question that I've sent there. The question reads, Wambui opened a small business in Miko on 1st October 2000. Her transaction for the month of October was as follows. So October opened a bank account second and deposited 150,000 and retained 50,000 in cash. And then on second, paid rent in cash 13,000. On third, purchased goods for 160,000 from Maru on credit. On fourth, sold goods for 260,000 in cash. On fifth, banked 230,000. On ninth, purchased office furniture 150,000 and paid by check. On 11th, purchased goods for 150,000 from Jumbo Traders on credit. And then on 12th, sold goods on credit worth 126 to Maya Traders. Hired transport on 12th and paid cash 10,000 shillings. On 13th, Maya Traders returned goods worth 16,000 and were given a credit note. On 16th, received a check 60,000 from Maya Exporters. And then on 19th, purchased goods for 19,000 on credit from Omolo. 21st, sold goods on credit to BX worth 15,000. On 23rd, so we have all those transactions. And then required, we want 3-column cash book, make relevant entries in the ledger and balance your accounts, extract a trial balance. So we want to do that question. We want to do that question. We want to do that question. So there is a cash book here. So we have the date here. Now the details. Then we have discount allowed. So we have the cash and then bank. So we also have the date, and then we have details, and then we have discount received. Then we have cash, and bank. So this is how the 3-column cash book appears. So for the purposes of column, we recognize those columns that records amount, which are 3: bank, cash, and discount. So 3. So it has 2 sides. We have the right-hand side and the left-hand side. The left-hand side is called the receipts or the debit side. And the right-hand side is called the credit or the payment side. So you must write the title. It's called Wambui 3-column cash book. 3-column cash book for the months of October 2001. So it is like opening. So we have combined. This is a cash account, and this one is a bank account. So, but we have combined them together. We have opened these 2 columns together, having the debits and then the credits. So every time you receive money in form of cash, you record it on the debit side. Every time you make payments in form of cash or through bank, you record it on the credit side. That is why it's called a cash book. So all the cash transactions, so it acts as a ledger and at the same time as the day book. So we're going to post. We're going to post here very fast. This is how the cash book appears. So this is how the cash book appears. So the first one, opened a bank account and deposited 150 and retained 50 in cash. So this amount that was posted in the bank account or deposited in the bank account was the amount of money that began the business. So the amount of money that we used to start the business called capital. So you're going to write here, this is October 01. So you're going to write here second. So here the capital, cash received from capital, 50,000. So you write here 50,000 and bank 150. Immediately you come a capital account. Immediately you come here and open a capital account. So you have debited and here you come and credit. So you write here second, 50,000. The same 50,000. The rules of double entry. If you debit, you've debited cash and bank capital. So this amount originated from capital. So every transaction must have at least 2 accounts. So when you posted in the cash received, we credit capital where it originated from. And then on second, paid rent 13,000. So he paid rent in cash 13,000. So right here second, the credit side, he paid rent cash 13,000 under the rent column here. Here you come here and open here, you don't wait. So you write here rent account, and then you write here second. You write here cash 13,000. So you've credited here, you debit rent. Remember, rent is an expense, and we said all expenses are debited. And then on third, purchase goods for 106,000 from Marwa on credit. So open a purchases account here. We're going to open a purchases account here. So this one is credit. The assumption is this information is being obtained from the purchases table. Now we were transferring it to the ledger, purchases ledger. So you're going to debit account receiving, in this case, the purchase account. So we write the date. Which is third, and then it's being received from who? From Marwa. The amount of receipt is 160,000. And then you'll open a Marwa account here. You're going to open a Marwa account. So you write there third purchases, 160,000. So you've debited here purchases because it received money from a supplier called Marwa. So this one will not appear in the cash book because it's not a cash item. The cash book only records items of cash or item of cash only, either through bank or hard cash that is received in the office. So that one we have finished recording on 3rd. You go to the 4th, sold goods for 260,000 in cash. So the cash, so here you write here the date, that is on 4th. You write here 4th. So cash received from sales. So you write here sales, it received how much? 260,000. You record under the column of cash, 260,000. So you come here and open a sales account here. You open a sales account here. So you write here sales account. So 4th, you write here clearly 4th. You write here cash, 260,000. Double entry. Cash lost to, sorry, sales lost to cash, 260. Cash received from sales, 260. The account that is receiving you debit, the account that is losing you credit, double entry. And then on 5th, banked 230,000, banked. To bank means cash lost 230, cash lost or paid out 200,000. Contra entry, an entry that is affecting both bank and cash. And then bank here gained 230,000 from where? From cash. From cash. So that is contra entry. Write the date 5th. Here you write 5th. That is a contra entry, an entry that is affecting both the bank and cash. So he deposited 230 of cash into bank. So it means the amount of money that was in cash was transferred to bank account. So cash paid out to bank. Bank received from cash. That is on 5th. And then on 9th, purchased office furniture, 150,000 and paid by check. So he purchased furniture and paid by check. So you write here 9th, you write here furniture and paid by check. The amount of money paid was 150. So you report under bank. So when you make payment under using check, it's bank. Then here you come here and record here. You write here furniture account. So 9's here, and then you write here bank 150,000. So he received the account receiving you debit, furniture has received you debit, the account losing bank has lost you credit. So remember, this side is the credit side of the cash book. That is double entry. And then on 11, that is the next transaction in the question that I'm having. I've only sent it to one person, don't worry. The others, I'll send it to you together with the answer. So purchase goods 130,000 from Jumbo Traders. So that is on 11. So you write here 11th Jumbo. So you purchase goods on 11th Jumbo Trader 130,000. So you write here 130. And then here you come here and open a Jumbo Traders account. So write here Jumbo account. So 11th, you write here 11th. You write here purchases 130,000. 130,000. On 12th, sold goods on credit 126 to buyer traders. So sold goods. So 12th here, you write here 12th, buyer traders. Sold goods on credit to buyer. So right here 126,000. And then you open a buyer's account here. Buyer's account here. So buyer is the one that is receiving from sales. So right here 12th, buyer is receiving from sales 126,000. So you've credited here, you debit buyer. Buyer is the recipient. So it goes like that. And then on the 12th, he hired transport and paid. So 12th here, so there's a transport. There's a transport. He hired transport and paid 10,000 shillings in cash. So right here, 10,000 shillings. You come here and open a transport account. You open a transport account. So there's a transport account. So you write here which date. Write the cash 10,000. Write the cash 10,000. And then on 13th, buyer traders return goods worth of 16,000 or given a credit note. So buyer traders return goods. So right here 16th. So right here returns inwards. Return inwards. So there's an account called return inwards you're going to open. The value 16,000. So right here 16,000. Then you will open a return inward account here. You open a return inward account. You open a return. You open a return inwards account here. Return inwards. So you've credited here, you write here 16. 16,000. So credit, debit. When a customer returns goods, you credit that customer because it's losing, and then you open another account called return inwards. You don't post it back to sales. You open another account, the account that holds all the returns from customers is called return inwards. So you don't post that transaction again to sales account. No, we don't do that. And then number 16, they received a check of 6,000 from buyer traders. Received a check. So he received a check, you come here and debit bank. You write here 16s, you write here buyer. He received a check of 6,000 from buyer, exporter, or traders. So you write here 60,000. Then you go to the very buyer here. Is it 16th? It is 16th. This other one was, the returns was on 13, sorry. The return was on 13th. But the payment, so this, the returns was on 13th. Then 16th, he paid bank 60,000. So the bank received, you debit, and buyer traders lost, you credit 60,000. And then 19, purchase goods for 19,000 on credit from Omolo. So right here 19th Omolo. 19,000. So right there 19,000. And then you come here and open Omolo account. You open Omolo account, and then you write there 19th. So 19,000. 19,000. The parcel goes to BX, what, 15,000. So on 21st here, you write here 21st under sales, write here BX 15,000. Then you come here and open a BX account. You open a BX account, you write here 21st sales 15,000. Write 15,000. And then on 23rd, paid Maro and company 144,000 in full settlement of the amount owed to them. So we have a person called Marwa here. So they were paid 144,000. 144,000. 6. So 144,000 in full settlement of amount owed to them. In full settlement of amount. In full settlement of amount owed to them. In full settlement of amount owed to them. So now here, when you check the amount that was owed to Marwa, so 160, 160, so minus 44. So it means full settlement means they were given discount. They were given discount. So in a full settlement means if the amount is less, then the difference is the discount. So this 144 that was paid cleared all the amount that was still owing. So the amount that's still owing is 160. So you come here and write the date. That is on 23rd. You write there 23rd. We have Mbaya. Mbaya was paid 144,000 through check. So you write here 144,000, and discount was 16,000. So you come here and write 23rd. So you say here bank 144,000, and then we have the same. We have discount received 16,000. So the double entry for discount will be observed at the ledger's level. So you open another account called discount received. So we have another account called discount received. So if you debited there, you credit here. You write here 23rd. You write here Marwa. 6. So I've completed the double entry for discount received. So discount received, the cash book does not observe the double entry. It's only a memorandum where we just record. But the real double entry is observed at the ledger's level, where you debit the supplier's account and you credit discount received. So that is how we post that one. We go withdrew 16,000 for personal use. That is on 24th. So right here, 24th. Any amount of money that is taken from business for personal use is called drawings. Any amount of money that's taken from business for personal use is drawings. So he withdrew 16,000 cash. So right here, 16,000. The cash is losing. And then here you open a drawings account. You open a drawings account. You open a drawings account and then you write here 24th cash 16,000. 16,000. So you credit the cash and you debit drawings. And then on 26th, both goods for 18,000 are paid by check. On 26th, so right here 26 purchases and paid by check right under here 18,000. And then you come here on 26, right here bank 18,000 under the purchases ledger. So you purchase goods through bank, so the bank is losing and purchases gaining. Remember we said purchases are debited. And then on 27th, BX paid by check 13,500 in full settlement of their debt. So BX, the amount owing from BX, the amount that BX is supposed to pay is 15,000. So here he paid only 13,500 in full settlement. So this 13,500 stood for the entire amount of 15,000. So right here BX 13,500. So the discount will be 1,500. So you write 1,500 under the discount column. Then you come to BX here. You note the date. You write here 27th. Bank 13,500. Then on the same date, there's the discount allowed of 1,500. Then here you come here and open a discount allowed account. Discount allowed account. Discount allowed account. So right here, 7th, BX 1,500. And then on 28th, paid by check, Jumbo Traders debt 10% discount. So 28th here, he paid Jumbo Traders. So you come and find out the amount owing to Jumbo Traders. The amount owing to Jumbo Traders is 130,000. So he paid less 10%. So less by 10% would be, the discount would be 13. So the amount was paid is 117,000. And then discount is 13 to make it 30. So right here, 28th, Jumbo is receiving, you say here, bank, 17,000. And then the same date, discount received, 13,000. You come here to discount received, 28th, you say here, Jumbo. You say here, Jumbo, which is 13,000. And then paid salaries 15,000. So that is on 31st year. So the salaries, he paid salaries 15,000 through bank, and he also paid water through bank, which is 1,700. So 1,700 was paid. So you open here a salaries account. So this salaries account here, salaries account. So you say here 31st bank, 15,000, 15,000. And then there is water. So right here 31st bank, 1,700. So that is how we post. After posting, you balance off the account. To balance the account means to compare the sides. You compare the debit side and the credit side, and then you take the difference. You write the difference of the side that is showing less amount. you take the totals and then you compare the amounts on both sides, the debit and the credit. And then you take the difference, you write the difference on the side that's showing a less amount. For example, in this capital, the credit side has 200,000. So you write here 200,000. This other side has 0. So 200,000 minus 0 is 200,000. So right here 31st, balance carried down. The closing balance here will be 200,000. Then here you come and write 200,000. You'll have balanced that account. And then the rent account, the debit side is 13, the credit side is 0. 13 minus 0 is 13,000. So you write on this other side that's showing less amount, you write here 31st, balance carried down, 13,000. So 13,000. 13,000. So you'll have finished that one. Then you come to purchases. Purchases, we have 160 plus 130 plus 19 plus 18. So total is 327. So this is 327,000. And then here you write 31st, balance carried down, 327,000. So you'll have balanced off that account, 327,000. Discount allowed. So right here, 31st, balance carried down, 1,500. 1,500. So you'll have canceled this account. Then here you come here. This one is balancing, doesn't have a balance. You write 160,000, Marwa, 160,000. Then you come to sales. Sales, we have 260 plus 126 plus 15. So this one is for 1,000. You write debit side is 0. So 31st here, you write balance carried down, 401,000. So 401,000. So that one. Then here 31st, balance carried down, 150,000. 150,000. So that is done, 150,000. Jumbo here is balancing, right? Just 130,000. And then here it's 130,000. That one will have color. Then buyer traders, 126,000 minus this one. So balance carried down here. Balance carried down here, it will be 50,000. So that one will have balanced. It will have balanced. And then you come here, transport 31st, balance carried down, which is 10,000. 10,000. So that one will have balance, 10,000 there. Then 31st here, balance carried down, which is 16,000. 16,000. That one is done, 16,000. Then 31st, balance carried down, which is 19,000. 19,000. 19,000. PX is balancing, doesn't have balance, so this is 15,000. 15,000. So discount, this is 29,000. So balance carried down here will be 29,000. 29,000. Then here water, balance carried down, it will be 1,700. Balance carried down under salaries, it will be 15,000. Balance 15,000 here. 15,000. So here balance, it will be 16,000. 16,000. You also come and balance off the cash book. So under the cash book, you take the totals of the debit side. So for instance, we have 50,000 and then we have 260,000. So that one gives us a total of 310,000. So 310,000 here. So 310,000. So 310, you minus 13,000 minus 230 minus 10 minus 16 minus 16. So the balance carried down here on that first, balance carried down here, it will be 41,000. 41,000 under the cash column. You do the same to, so we have 150 plus 230 plus 60 plus 13.5. So this one will give you 453 or 53,500. Then you deduct minus 150. Deduct 150 minus minus 144 minus 18 minus 117 minus 15 minus 1.7. So this one becomes the balance carried down under the cash under the bank column with 7,800, which will give you 453,500. So that is how we balance off. Then we finish up by drawing the trial balance. A trial balance is a statement that summarizes the balances in the ledger. A trial balance is a statement that summarizes the balances in the ledger. So you have that it has the debit and the credit. It has the debit and the credit. A trial balance is a statement that summarizes the balances in the ledger. So for instance, here we start here with water. We start here with water. Or let us start with the capital here. So if the credit side was the greater side when balancing off, that one is called a credit balance. When the credit side was the greater side when balancing off the account, then that one will be called a credit balance. So you check if the balance carried down is on the debit side, then it means the credit side was the greater side. Therefore, that is a credit balance. So under capital, we're going to write here capital. So that is a credit balance of 200,000. So we write here 200,000. After capital, we have rent. Rent is a debit balance of 13,000. And then we have purchases, debit balance of 327,000. And then we have discount allowed is a debit balance. Discount allowed is a debit balance of 1,500. Marwa has no balance. Sales is a credit balance of 41,000. So right here 41,000. And then furniture, a debit balance. Furniture debit balance of 150,000. Jumbo Traders has no balance. Buy Traders is a debit balance of 50,000. So 50,000. Transport of 10,000. And then return notes a debit notes is a debit balance of 16,000. We have Omolo is a credit balance. Omolo is supposed, we did the wrong thing. Omolo is supposed to have been here. Omolo is supposed to be the 19th here. Supposed to be have been purchases here. 19,000. And then here we have what we call balance carried down. This Omolo is the one that sold. So Omolo is a credit balance of 19,000. BX has balance. Discount received is a credit balance. Discount received is a credit balance of 29,000. And then drawings is a debit balance of 16,000. Salaries is a debit balance of 15,000. And water is a debit balance of 1,000. Bank is a debit balance of 7,800. Then what cash is a debit balance of 41,000. So when you add this side, that is how a trial balance appears. It's a summary of the balances in the ledger. So the both sides need to be the same. So here we have 200 plus 401 plus 19 plus 29. So this one, both sides will be 649,000, 649,000, 649,000. So that is the end of that particular question. So in this question, we posted in the ledger and we posted in the ledger accounts, and then the ledger account must be balanced off at the end of the period. So that is how that question is done. That is how that question is done. In case you have more questions, you will post, then we'll be able to respond to them later on. I'll give you the notes including this question and its answers. Until the next time, our class for today will come to an end at that point. So we'll keep on communicating when we have the classes. They will always be on Tuesday at this time. Thank you very much for your participation.